This is Ingrid Jarrett, President and CEO of the BC Hotel Association. I'm wishing you a warm welcome on behalf of myself and my team, and Brian Stanford and David Ferguson with CBRE, our great partners in the state of the accommodation industry. And they're always great partners for us, both at our summit, but also from an industry expertise perspective when we're looking at how the industry is doing. We're delighted to have both gentlemen with us this morning, and they'll be presenting the state of the industry. So thank you very much. As I did say, this is being recorded and will be available. So in case you can't remember what I look like, there's Ingrid Jarrett, and next to me is the infamous Mike McLeod, who is our Director of Member and Business Development. Thank you again for joining us this morning. And I'd like to introduce, we have on the line David Ferguson and Brian Stanford. They're both experts when it comes to CBRE, and we're really delighted, and thank you, Brian and David, for sharing your expertise with us. And I will hand the webinar over to you.
Thank you, Ingrid. Thank you, Mike and Carissa, and to all the members who have joined us this morning. We appreciate you taking time out of your busy schedule to share with us what we've our latest round, I guess, if you will, of trying to help the industry understand what's happening and where we're going to go from here, for lack of a better way of putting it. And obviously, the uniqueness of what we are going through right now presents significant challenges in terms of trying to plan for going forward and trying to grasp and cope with what we've been through in the past. So we're going to share a little bit of that today in terms of where we've been, but more specifically, a good discussion, we think, this morning on where we're going, and a little bit different context in terms of, normally our Outlook presentations focus more on top line issues going into the future, but we're going to present a little bit more this morning on issues to do with cash flow and liquidity. And I think that hopefully you can benefit from it, and we encourage you, if you're representing your asset or representing your owner, perhaps share the information with them. Or if you are an owner, perhaps think of key personnel that you work with that you may want to share this information after the presentation as well. And in some instances, some of you may be in a position that you need to share or want to share some of these thoughts with your lenders as well. And so without further ado, let's kind of just move forward a little bit. A lot of the work we've been doing on, how we're coping with COVID, or where we're going to go in terms of the sector, what's happening with hotel values, et cetera. We've been preparing these forecasts. We've relied a lot heavily on the research that we undertake through CBRE's global research teams. We've taken into consideration what's happening in Europe, what's happening across Asia, and of course, what's happening across all of the Americas when we're trying to figure things out. So again, that's just a lot of the information that we're working with is coming from within our own databases. And some of these on the screen you may recognize. Many of you do participate in our monthly occupancy report, trends in the hotel industry. We have over 55% of the rooms across the country that we do get monthly top line data on. With our financial trends publication, over 30% of the rooms in Canada are represented in our annual financial publication, including us segmenting out some BC stats, for example. And we've been doing that for more than 40 years. And of course, our industry outlooks, we've been doing them, annual outlooks we've been doing for 20 years. Certainly within BC, we've been doing them for more than 20 years as well. So, hopefully that, when we're looking at data today, while we do look at some other groups' data and we work with their information as well, we're thankful that we can do a lot of our analysis in-house with the participation of you, the members. We're grateful for that as well. So, without further ado, let's kind of move forward a bit and think a little bit about where we are. I mean, it's been about 7 months now, really, since the lockdowns really started to come into effect. At that point, of course, there was a ban to Canada of all foreign nationals from other countries except the States. And for that matter, people coming from the States only for essential travel that they're allowed to come into Canada. So those travel restrictions really haven't been lifted in any significant regard, and we have to continue to work with it. We are now also being, unfortunately, bombarded daily with news across the country of upticks in COVID cases and comments about second waves here in BC. Of course, I believe we hit a record yesterday, over 200 confirmed infections in a day. So again, there's still a lot of uncertainty with regard to the number of infections we're getting in the country and where that's going to go and how bad it's going to get and when we're going to come out of it. So it's, the issues with economic uncertainty. It's been about 6 months or so actually now since we shared our initial perspective with the industry on the potential impact on the hotel sector here in Canada. And since that time, we've spent a lot of our effort speaking to owners, speaking to operators, brand representatives, industry associations like yourself, but very importantly, we've also been speaking to a lot of lenders with respect to the impact of COVID-19 on the sector. Very important that we've been talking to, lawyers and insolvency people as well as to what is going on in the sector. So again, we're trying to gain perspective from many different angles here as we look at going forward. Now, some of you have probably seen some of our presentations already and some of our COVID outlooks, either possibly through our quarterly updates, or of course, we are still doing our quarterly presentations to HAC, the Hotel Association of Canada. So there may be a little bit of overlap with some of that information you'll see today, but we've also got some content that's very BC specific for you. It's worth mentioning that we have not moved significantly on our expectations for recovery relative to the original forecasts we put out in May. And while our views at the outset, we were probably deemed a little bit more pessimistic relative to some other forecasts and industry groups we're looking at out there, but I think it's safe to say now that based on year-to-date results, that some of those groups are probably more in line now with the kind of thinking that we were looking at in terms of where the industry was going to go. So much of the discussion during the initial months of the pandemic really focused on erosion of value. At the outset of the pandemic, our concerns were more focused on liquidity and cash flow issues throughout 2021 than they really were on the impact of value. And Brian's going to discuss this in greater detail for us this morning. So on a good news side of things, there have been several announcements very recently that the BCHA has shared with you, other industry associations have shared with you with regard to, what the federal government's doing to, extend the wage subsidies, other financial assistance programs, and some of these, of course, now extending right out and through into next summer. So that's very positive for the industry because that's going to help address these issues with cash flow, with liquidity that we will identify and talk about in more detail. When you look at the economic side of things, there isn't a forecast out there now that isn't going to show that the economy is retreating. The GDP is going to be a negative territory for every province across the country for this year. Most of the forecasts are still leaning towards the notion that there will be pretty decent GDP recovery next year. It varies by province, and in most cases, if you look at it on average, it's probably about 4.5% to 5.5%. There may be a couple of exceptions in there, but again, for the most part, there's this attitude still that while we're having a really difficult economic year this year, things will get better next year. But of course, while those growth expectations are important, what's more important to our sector is the timing of recovery in business travel and in leisure travel. This will be much about easing travel restrictions as it is the willingness of businesses to let their employees get out there and travel, and the willingness and comfort of all of us leisure travelers to be willing to get out there on our own and travel for leisure or meeting conferences or crew reasons or whatever. So in our minds, the introduction of an effective vaccine is going to go a long way, obviously, to eliminating this uncertainty. And the forecasts we're going to share today, for example, are predicated on the assumption that there is a vaccine available in 2021, starting around Q3, and that at some point, obviously, in the not too distant future, we also have some easing on the border restrictions as well. So, okay, with all that as a backdrop, let's get into some numbers for you and show you where we're going. At the national level, very, very quickly, pay attention to the headings on some of the slides today because there's certain slides that we're presenting certain bits of information, and on other slides it's slightly different information. But on this slide, what we've done is we've broken out year-to-date results by quarter. So again, if you look at Q1, in most parts of the country, the year started out pretty positively. January, February, with a few exceptions, REVPAR was actually pretty much holding its own. And then, of course, everything really fell apart when we got into March, particularly the second week of March. And a lot of areas of the country missed their usual good opportunity for some good pickup in March during March break, right? We had provinces were staggering March breaks this year, for example. It's a good conference month typically, but we lost a lot of that momentum. So REVPAR was off 18% through the first quarter. The second quarter was obviously by far the worst, whether it's here in BC or across the country, with lockdowns that went on and the absolute ceasing of travel. We had REVPAR decline in Q2 across the country of about 82%. And while we haven't completely finalized our numbers for the end of September this year yet, based on what we have in-house, we're pretty comfortable with what we have, that we have REVPAR through the third quarter is going to be off about 65%. Okay. Obviously, July and August, there were, to a lot of people, July and August were sort of, not the savior months is too strong a word, but they were hoping they could salvage something of their year by having a fairly decent summer period. And in some parts of the country, we did, some parts we didn't, but we, as you can see, REVPAR was still off 65% through the third quarter. Did it matter where in the country you were as an operator? Not particularly, although if you notice, if you look at the West, the REVPAR declined through Q3 at about 60%. That was a lower decline than what we're seeing in through Central Canada and Atlantic Canada. And a lot of that can be attributed to performance results here in BC in the third quarter. Did it matter what type of property you had? It certainly has to some respect. Not surprisingly, full service hotels, which you'll often typically find in city centers or in the urban cores of major and secondary markets, they've been hit the hardest. There's no meeting conference activity, as you know, very little in the way of corporate travel, a lot of reluctance for people to want to go into the city centers where they could potentially have huge exposure to everything from other guests in the hotel to more people on the street or in the parkades, whatever. So again, very dramatic drop off in the full service side. With limited service, and with limited service, we're also talking select service assets as well. They really have been, throughout the year, more sort of type of asset that people have been going. So whether they're in a suburban market, whether they're in a tertiary market, for example, whether they're interior corridor assets or exterior corridor assets, limited service has seen a little bit less impact. And the resort sector is particularly Q3, not surprisingly, folks in BC got out, or people from other provinces got out into BC in the summer and hit some of the better known resort areas. And so you saw, the percentage decline in REVPAR through Q3, not surprisingly, not as dramatic on the resort side. So with all these markets we track across the country, we kind of wanted to take a look about, again, where some areas are faring better, where some areas may be faring worse. And as you can see on the slide, there are a lot of markets here in BC that, now this is just the month of August we're showing. And you can see that if you look at REVPAR in 2020 versus the same month in 2019, you can see most of the markets, there are a lot of markets there are actually BC markets where there was not that significant a drop. And in fact, I had to go back and check the numbers twice. And in fact, Penticton actually had REVPAR growth in the month of August compared to the same month last year, largely through achieving improvements in rate. But you can see there, so it is a good news story in a relative term. Some other markets, downtown Edmonton with hockey, for example, and then some drive markets in Northern Ontario did all right. So who's been hit the worst? Well, this probably won't come as a surprise. It's the cores of some of the most, some largest cities in the country. So, the urban cores of 4 of the major markets. And then you also can really put Halifax in there because we don't break Halifax out by sub-market. And then the other areas that have been hit the worst have been airport markets. Again, with the significant drop off in travel and no business travel, these shouldn't be surprising. But airport areas, downtown cores of major cities, Niagara Falls, of course, with the border closed, they're losing all that normal traffic they get in the summer months that comes across from New York. So let's turn our attention to BC. And again, we'll start off going quarter by quarter. And as you can see, Q1, and I'll show you in a couple of other slides coming up. Again, BC, momentum wasn't too bad on the occupancy and rate side through January and February. And in March is when everything really fell apart. And as you can see through Q2, very, very dramatic declines. Over an $80 drop in ADR in Q2. REVPAR down to $27 in Q2. I would bet if we went back 30, 35 years through our databases, there probably would not be a time within the last 30 years where we would hit quarterly REVPAR as low as $27 across BC, and that's where we ended up. Q3, we're looking at probably being down roughly 63%. Again, I talk about that whole idea that we were hoping to hit 45% occupancy in the summer months. BC got there better than some of the other provinces, as I'll show you on this slide here. So here is occupancy month by month for 2020 in the dark green versus 2019 in the light green. And as you can see, obviously in April was when things really fell off. And then as people started to travel a little bit more, as restrictions started to ease, we started to see the performance results get a little bit better. Still a long way to go. And if we look at August, for example, BC occupancy in August hit just shy of 53%. Just to put it in contrast for you, Prince Edward Island also happened to hit 53% for the month of August. But not one other province across the country even made it to 43% occupancy in the month of July. So again, it's not a good news story in some respects, but certainly BC Hotels did fare a little bit better through the month of August than some of their counterparts across other areas of the country. And then with September, we're starting to see almost a normal curve, if you will, drop off after the summer traffic as we head into the fall. Looking at rate, very dramatic story. That spread you can see here is quite dramatic in terms of where rate has been this year versus last year. If you look at August, for example, rate in the province was off roughly $70. I'm going to show you in a second here numerically, but again, for a contrast, rate for the province was off $70 in the month of August. Rate for the month of rate for Metro Vancouver for the month of August was off $128. Very dramatic impact. Looking at it from a REVPAR perspective, again, the numbers are not pretty. The month of August, for example, REVPAR in 2019 across the province hit $196. And for 2020, we were at $83 for the month of August. So let me turn our attention for a moment to Metro Vancouver. And as a reminder to those, Metro Vancouver's room inventory makes up more than 25% of the provincial total. And so what happens in Metro Vancouver obviously does certainly have some influence on performance results for the province as a whole. In Q2 in Metro Vancouver, 88% decline in REVPAR was higher than the provincial decline. Occupancy in certain subsectors of Vancouver, in downtown, for example, it went as low as 9% one month on the assets they were open, never mind the assets that stayed closed for some of those months as well. So you can see here, very dramatic drop-offs in performance, more than $200 decline in REVPAR in the month of July, and very close to nearly a $200 decline in REVPAR in the month of August. And REVPAR down over 80% through Q2 and throughout July and August as well. Looking at it by the submarkets in Metro Vancouver, downtown again hit by far the worst. Richmond, you have to be careful with the Richmond stats. As some of you know, some hotels were used for housing people that needed to be quarantining, returning guests. There were some hotels that were housing essential workers at significantly discounted rates. Very admirable thing to do. It did have a little bit of an impact on where they were in terms of REVPAR decline. You get out into Surrey Langley, and then you go across all the other municipalities in Metro Vancouver. Again, a very devastating story with demand drops and significant declines in REVPAR. Looking at it again graphically, I already told you the month of June, REVPAR down more than $200. The month of July, REVPAR down more than $200. The month of August, we were very close to that $200 level. And again, very dramatic. Again, Vancouver was surging so well in terms of occupancy last few years and the significant rate growth the city was able to achieve. and a lot of that has really just fallen right off completely. So here's a busy slide, but let's kind of take a look at some of the other markets we track across the country. So our dark green bar are year-to-date changes in REVPAR compared to last year, and the green is just for the month of August. I won't talk to too many of the submarkets. You can see them on the screen. Obviously, you know, some of those leisure markets or markets that were able to pick up a lot of leisure activity in the summer months. It certainly has helped their performance results, but there is no good news story when you're down this much in REVPAR, regardless of the percentage across the province. The other thing I wanted to share is that while in our trends data, we report a lot of submarkets across the province. We you know, provide data for a lot of the markets in Vancouver, coastal tourism region, for the islands tourism region, but there are a lot of operators out there in different parts of the province that don't get a real indication as to what's going on. So we did some digging through our database and kind of cobbled up some stats together for you. And as you can see, for the coastal Okanagan tourism region, Caribou, Chilcotin, Kootenay Rockies, and northern BC, we've been able to get some data together for you here. Dark green is where Q1 REVPAR declined, Q2 in the lighter green, and then year-to-date to the month of August. And if you dig a bit deeper into some of the statistics, you might look at the percentage drops in year-to-date and think, wow, that doesn't seem as dramatic as it seems to be for me as an operator. One of the biggest differences is what's happening in some of these regions compared to, say, Metro Vancouver is not only is there a decline in significant decline in demand in Metro Vancouver, but rate has dropped off so dramatically. And when we went through this data, what we found in a lot of these regions is rate isn't that far off year to date from where rate was last year, but demand is down substantially. So occupancy is way down. So no doubt about it, your rooms are empty. It's hard to find hours for your staff. You're not getting any food and beverage revenue or revenue from the other sources. So by no means, if you're seeing these percentages of 29, 31, 34, and not think that there isn't devastating impact going on here. There most certainly is, but you haven't had as dramatic a drop in rate in a lot of these locations. And as a result, that's why the percentage change in REVPAR hasn't fallen off as dramatically as when you look at the province as a whole, or when you compare it to, again, what's going on with Metro Vancouver, or even the national numbers as well. So that's a lot of fun, what's going on so far in terms of where we have been. But I want to turn it over to Brian now, and Brian's going to talk about how we're going to come out of this situation.
Thanks, David. As David mentioned, it's been almost 7 months since we saw the true onset of the pandemic here in Canada, and about 6 months since we released our initial perspectives with the industry on the potential impact on the hotel sector here in Canada. And it's certainly fair to say that, while we clearly have a better understanding on the degree of short-term impact on the industry, at least through to the end of the summer, we still don't have a clear understanding of what the recovery will look like. And having said that, we've mapped out a recovery framework from both a top line and bottom line perspective that demonstrates the challenges that the industry continues to face. And certainly as we look at recovery curves, and David mentioned it, our databases go back over 40 years in Canada. And so one of the things that we have the ability to do is learn from historic events. And that's not to say that history will repeat itself, but it does provide some framework for consideration. So on this chart, we've examined the occupancy and occupied room nights nationally in Canada over the 1998 through 2019 period. And the history post 9/11, SARS, and the Great Financial Crisis suggests that demand levels actually came back to pre-incident levels relatively quickly, within 12 to 15 months. And there's no doubt we are in a far more dramatic situation today with lockdowns and hotel closures, travel restrictions. However, history does show us that demand levels will come back. The big unknown for all of us is really the timeline. And certainly as we look at bottom lines, I mean, post 9/11, post SARS, and post the Great Financial Crisis, the recovery of ADR and REVPAR lagged the demand recovery by about 12 months. So when we combined impacts of occupancy and average daily rates, they were impacting top line performance. And as a result, the industry experienced significant downward impacts on operating profit subsequent to each event. Post 9/11 and SARS, we did not get back to our peak 2000 income levels again until 2007. That was a full 7 years later. And post the great financial crisis, it was another 7 years, 2015, before we hit 2000 levels of profitability again. And as we look at those 2007 levels of profitability, that was essentially getting us back to where the industry was in 2000. I mean, the good news nationally, we were at all-time highs in industry profits coming into the cycle, and with unprecedented growth of the 2016 to 2019 period. And with 2018 and 2019 operating income over $15,000 per room, that was 30% above the 2000 and 2000 historic highs. And the situation coming into this downturn in BC was even stronger, with profit levels exceeding $25,000 per room provincially, 70% above the national level. So as David mentioned at the outset, as we look at our outlook for Canada, we're working off an adjusted recovery line relative to that prepared by our global research teams for Asia, Europe, and the Americas. And certainly our expectation is that our recovery framework in Canada will parallel the timelines expected in the US. Our forecasts, as David mentioned, are based on a number of key assumptions. And one that's worth mentioning, when we prepared our original forecast back in April, one of the key assumptions at that time was related to the ability of the travel industry to manage social distancing requirements and the ability of the accommodation industry to make the required operational adjustments. Over the last few months, the industries clearly demonstrate the ability to accomplish these requirements. I think that's certainly no longer a caveat in terms of how we recover and how we manage the process going forward. Now, as I mentioned, we released our original top line outlooks back in April, and at that time we were projecting a 50% decline in REVPAR this year. And even with recovery, we still expected 2021 to be about 20% below 2019 REVPAR levels. And it was 2023 before we expected to get back to 2019 top line occupancy, average daily rate, and REVPAR levels. And as David noted, industry performance was impacted the greatest at the outset of the pandemic, with national REVPAR in Q2 off more than 80% relative to 2019 levels. And there was initial hope that the summer months would bring some level of relief. And while performance levels were up, they still fell short of our expectation, with REVPAR off by over 65% during Q3. So having said that, we're not moving off our 2022 to 2025 recovery curve, but clearly 2020 will look even worse than the 50% REVPAR decline we were originally forecasting. And the prospects for a far weaker start to 2021 than we originally anticipated are clearly in the works. And it's also important to understand how we're measuring recovery. It's not about getting back to where the industry should have been 3 to 5 years out pre-COVID. In reality, it's getting us back to where the industry was pre-COVID coming into 2020. Now, I mentioned that we expect to fall short of our original 2020 outlooks for the recovery. And what we're showing here is we're tracking on a monthly basis actual results nationally, that's the blue bottom line, versus our original forecasts, the dark green middle line, versus the 2019 actual results, which is the light green top line. And as David mentioned, we fell short of our summer, July, August, September occupancy forecast of 45%. And our expectation is that the balance of the year will still be off, as will the early part of 2021. But we still expect to be back on track with our projected recovery curve by next summer. And I say our projected recovery curve, not historic levels. Going forward, we expect the performance gap to close relative to historic levels by the end of 2022. And as you can see on that chart, our expectations coming out of next summer is for us to get back to historic levels of demand by the end of 2022, with full recovery from a top line perspective commencing in 2023. And when we bring average daily rate into the equation, the impact has been even greater than we thought. This is in part pricing, but it's also in part the impact of the closure of a disproportionately higher number of larger full-service upscale assets in the downtown cores. And similar to demand and occupancy, we still expect the performance gap in ADR to close over the latter part of 2021 and to get back to historic levels out through the end of 2022. we combine that occupancy and ADR curve for our REVPAR forecast, that trend line shows the same gap year to date, that gradual recovery and that expectation that 2022 year end will lead into top line recovery by the end or throughout 2023. Now, as I mentioned, we spent a significant amount of time over the last few months, and David talked about it at the beginning, speaking with owners, operators, and as importantly, lenders. And many of the questions that were coming forth in those discussions were all about value. And as David mentioned, at the outset, when we spoke to operators, we spoke to the lending community, we were more focused on liquidity and cash flow. So, what we've modeled here is monthly operating performance for the industry at a national level on a go-forward basis starting June 1st. And just to explain that chart a little bit, the dark green bars are monthly revenue. The light blue line is monthly expenses, and the light green bars represent adjusted net operating income. So essentially operating profit before debt service. And in our view, even with effective operating adjustments, it's going to be the summer of 2021 before we begin to see some true sustainability in operations at a national level. And as we layer in some basic financing costs, what we really see and what we're showing here is the dark green bars are the operating profits picked up off that last chart. The light green bar is monthly cash flow after interest payments. And I'll call it the light green or yellow bars are monthly cash flow after both principal and interest payments. And as you can see there, it's the summer of 2021 before we expect most assets across the country to be able to fully cover full principal and interest payments, with some continued challenges even in the latter months of 2021. And for better or worse, this is the message we've been communicating to both owners and lenders. And that's important both from your business planning perspective, but also for the lending industry to understand that there is a recovery timeline, but it's going to take us some time to get there. Now, as we look beyond 2021, we're forecasting operating income out to 2025. As I mentioned, the industry finished 2018 and 2019 at more than 15,000 per room in profits, and that was historic highs. Our projections for 2020 are for virtually no profit levels this year. And even with strong growth in 2021, our original projection for operating profits were still 45% below 2019 levels. We do expect bottom lines to grow from there, but even as we look out to 2025, our expectations are for operating profits to still be 5% below 2019 levels. As I mentioned, it took 6 to 7 years post 9/11 and SARS for industry profits to get back to historic levels. And it also took 6 to 7 years post the great financial crisis to recover. Our expectation at this time is for a comparable recovery timeline coming out of this pandemic. And with the significant top line and bottom line impacts, there's clearly been an impairment on value. And this will lead to certainly some distressed assets. However, in our view, the greater concern may be the impairment on balance sheets and cash flow from an owner's perspective. And certainly, as we talk to these issues with owners, and we talk to these issues with lenders, one thing that we have done in our valuation process is try to communicate these implications as I go forward. And in any appraisal that we're doing today, be it for the lender or the owner, we're essentially been providing three values. One's a value at today's date, and that's reflective of the immediate challenges. And as you can imagine, at the outset in April and May, those challenges were certainly more significant than they are today. But we've also provided value as of January 2021. And that's in an effort to mitigate the impact that 2020 cash flow has had on value. And more importantly, we've been providing a stabilized value as at 2025, showing the industry having fully recovered. And I think that's important because we all recognize that value, well, it's a balance sheet issue, cash flow and recovery are more important. In our views, and CBRE actually just released today our Q3 real estate cap rate survey, which includes our views across the country on capitalization rates across the hotel sector. And in looking at values and in our discussions with lenders and our discussions with owners and investors, we're not adjusting cap rates. In our minds right now, cash flow is the primary impairment on value. And certainly as we look at these numbers, our modeling suggests that, at least on paper, value erosion is about 20% on a January 1st, 2021 value versus the December 31st, 2019 value. And as we look out to 2025, at least on paper, we see stabilized values 5 to 10% below a pre-COVID value. Now, as we're going through asset-specific appraisals across the country, in the downtown cores of Vancouver and the suburban markets, in the rural markets, certainly what we're seeing is a much broader range of impact. In some cases, as low as 15% impact on value relative to pre-COVID levels. In other areas, as high as 30%. But the challenge we have, and the validity of this is really hard to understand, because to date there have been very few transactions that we can rely on to validate this one way or another. And as we talk to owners and lenders and talk further on this whole issue of cash flow and balance sheet implication coming out of COVID, and I think, as I mentioned, in our minds, it's likely next summer before the industry is fully positioned to meet its full debt service obligations. There will be a long-term impact on balance sheets. In our analysis, we've assumed that lender has deferred both principal and interest payments out to June of next year, and that the deferred interest components added to the outstanding long-term debt component, under full amortization at that time. So what we have is a potential 20% erosion in value. We have a certainly additional debt liability coming on top of current financing elements, and therefore we have a corresponding erosion of owners' equity. So if we take this analysis, we've got a 60% loan-to-value asset coming out of 2021 with sufficient cash flow to cover its full debt service obligations and to be on site on its debt service coverage requirements. However, it's going to likely be offside on its loan-to-value. So, as we see the erosion of value combined with the additional long-term debt, that 60% loan-to-value asset comes out of COVID closer to 75%. In almost every situation and every lender that we're speaking to, they understand this and have indicated, their willingness to work with borrowers through this scenario. Where we have concerns is where an asset was highly leveraged going in, or was overvalued, or is underperforming coming out of COVID. In those cases, the challenges are going to be a lot greater. And in these cases, it's questionable whether there's sufficient cash flow to cover full debt service obligations coming out of COVID, let alone be on side on a debt service coverage or loan-to-value perspective. And certainly the challenge for many lenders and many owners is just determining what this looks like coming out of COVID, and does it still make sense for either side. It's unfortunate to say, but we do believe that there will be distressed assets, there will be bankruptcies, there is certainly going to be some fallout as a result of COVID. Now, having said that, there have been a number of bankruptcies and hotel closures of late, but most of those have been Alberta. And it's fair to say that most, if not all of those, were in trouble coming into 2020. So, what does the recovery curve look like, or what does the recovery trend line look like? Well, we typically talk about the coming out of COVID, or out of the current COVID environment, in really a 4-phase framework. And we've come through the initial phase of impact and short-term relief, and now truly moved into what we define as the survival phase. After sub 20% occupancy nationally, we're still sub 40% today, which has been leading to eroding profitability and resulted in some temporary hotel closures. The industry has been supported by government wage subsidies, government short-term loan programs, and lending industry deferrals. And though we don't know the details, it's certainly good news that the wage subsidy programs, as David mentioned, the financial assistance programs have been extended out through next summer. But certainly, whether we're sitting in British Columbia, whether we're sitting elsewhere in the country, the short-term objective of an operator still remains simply to stay alive over the next 12 to 18 months. So, as we look at, it really being the latter part of 2021, early 2022, with the prospects of a vaccine in place, that we really start to see the true start of the recovery phase. And it's not until 2023 until we see the industry getting back to 2019 levels of top line performance. And it's not until 2025 until we see recovery from a bottom line perspective. And so those timelines and the challenges of getting from here to there, are certainly, issues that we face across the country. And it really is going to be hard to say what the new normal will look like from an operational, from a consumer perspective. But certainly, I think some of the short-term operational and consumer changes that we've seen today will remain in place in our new world coming out of this. So what does this mean to British Columbia? Well, kind of taking that analysis and that framework, we've looked at both the top line and bottom line performance across the British Columbia hotel sector, over the last 20 years. What we're looking at here is the historic REVPAR performance across the province, and we're comparing Vancouver to the balance of the province. And as David mentioned, when we look at the provincial numbers, the strength and depth and significance of the room counts in Vancouver go a long way to influence the provincial numbers. So when we separate the two, it actually tells a very encouraging story. Post 9/11 and SARS and post the great financial crisis, the top line recovery for both Vancouver and the balance of the province actually met and actually exceeded the national REVPAR recovery curve we saw across the country. And in fact, the $125 REVPAR for the balance of the province outside of Vancouver in 2019 was 25% above the national level. So we came into this challenge, into this period in British Columbia far stronger than we did anywhere else in the country. And we certainly came into it after a period of unprecedented growth. And as that curve shows, when we look at Vancouver, we look at the balance of the province, the growth that we saw driven by both improvements in occupancy and improvements in average daily rate over the 2014 to 2019 period were huge. And in fact, in both aspects, both Vancouver and the balance of BC led the country in growth over this period. If we take it a step further and look at profitability, and we haven't broken out the operating profit data for the province regionally, but as we look at it at an overall level, it tells the same story as we saw nationally, with operating profits post 9/11 and SARS fully recovering by 2005. So actually a little bit quicker than we saw on a national level. And post the great financial crisis, fully recovering by 2024, the latter part leading into 2025. And similar to the top line, this was followed by unprecedented levels of growth in profits over the 2015 to 2019 period. So as we look at British Columbia and we look at history, it tells us a few things. One, that demand will come back. And in BC, the new supply construction of hotel product has been and will continue to be relatively low on an annual basis. And that really means that not only will demand come back, but so will occupancy. And in our minds, Vancouver will lag a bit behind the balance of the province, in that recovery timeline. And certainly, I think energy-related markets in the north specifically are going to continue to benefit from construction projects in the short term, and that could certainly help minimize COVID impacts in those markets. As our starting point, BC, as I mentioned, was the most profitable province prior to COVID on a per room basis. So it may be a lofty target to get back to that level of profitability, but we believe it's achievable in most areas. And however, in BC, I think it's important to remember that the recovery and profit levels will be as influenced and maybe even more so influenced by ADR recovery than just simply demand recovery. And we certainly don't want to diminish the challenges you as operators have faced and are going to continue to face as a result of COVID-19. We believe the provincial accommodation sector in British Columbia will come out of this downturn stronger than most other provinces across the country. That doesn't lessen the need for a strong operational and business planning efforts over the next 12 to 18 months to ensure that you come out the other side. But certainly in our minds, the starting point coming in was as strong as it could possibly be. And coming out of this, the recovery timeframes, the recovery framework will be extremely strong. So at this point, we'd like to thank you for your time and interest and would like to open the floor to any questions.
Thank you so much, David and Brian. I mean, very sobering, but very, very informative. We have a chat function at the bottom of the screen, and if anybody that is currently online has a question for Brian or David, please use the chat function, and we will accordingly do our best to answer that. I'm just watching for the chat. I think one of the things, Brian, with the recovery timeline that I'm thinking about is there's much concern without the current commitment from the federal or provincial government to support that concern around liquidity. And so certainly the reality check of the value to the asset and how people will be managing that. I think, just sort of seeing it from your perspective and looking at the timeline, it enables sort of some business planning to occur, which would include your expertise.
Yeah, it's certainly been interesting, Ingrid, as we've been, and I want to be careful how I say this, but there's been as much, I think, an education process going on within the lending community on how to battle this challenge as there has been for all of us that work within the industry. And it's easy for me sitting here as a non-operator to kind of look out 12 months and say, once you get there, you're going to be on the other side, and it may not look as good as it did, but you're going to be in good shape. It's been really encouraging that almost every lender that we talk to has a desire to work with their borrowers. And as I think, David and I talked about in the presentation, unless there was a challenge going in, they understand that there's a solution here and how do we get between here and then. And I think the big message for any of your members is, and I'm sure most of them are doing it, but if you're not maintaining an extremely open and transparent line of communication with your lender, start doing it now.
Right.
Because there's nothing that they want any less than is a surprise. And some of them maybe were in a bit of denial, they being lenders, in a bit of denial coming into this. They're now realizing that this is not one file or two file, this is an industry problem. And the solution has to be, how do we all get to the other side? And I'm not saying that there won't be some assets that and owners that unfortunately, get bad news out of this, but they will be the minority.
Yeah, well put, Brian. I think some of the other things that it's probably appropriate for me to point out is, as the industry association, and we're thinking about this timeline by which to recover, we're really focusing on opportunities to impact that NOI number. So how do we currently operate, and how can we operate and provide intel and whether or not it's energy savings or commission savings or that kind of thing to make sure that we positively impact that flow. And then the other thing that we're doing is providing education for middle managers, upper managers around financial management in a time of crisis, revenue management expertise. Given that 55% of the properties in British Columbia are non-branded independents, I think there's a significant opportunity for us to be really making sure that there is an understanding around the REVPAR and your ability to monitor demand and supply and potentially be able to affect that flow number, which will make sure that your banker sees that what you're doing with the revenue that you have to play with, that you're making sure that you're managing it really well. So for those of you on the line, please make sure that you check out those education sessions that we have. There's a series that we're launching next month. We'd love you to sign up for them. And David and Brian, it's always such a pleasure to hear the work that you do and the way that you're able to analyze the markets for us. And it's I can't use the word refreshing because it's very dire, but we're also in a country where we can see the difference British Columbia has in comparison to other regions. And, you know, we hold that unfair advantage true. And when we're going into the future and we know what we're doing well, there's, you know, a glimmer at the end of the tunnel, although I know we've got a few years in which to get there. So thank you both very, very much for your time and your expertise and willingness to share that with us today. I'm not seeing any questions for you, so I think we can bid adieu. Thank you again.
Thanks, everybody.
We have lots of comments in the chat of thanks to both of you. So I think very, very helpful.
Wonderful. Thank you.
Thank you
Okay.
for.
Thank you.